Hey everyone, welcome to the Nitty Gritty of Real Estate Podcast. Today we're talking about assumable mortgages. Let's get into it. Hey everyone, today we're going to be talking about assumable mortgages with Nick Woolridge from VIP Mortgage. Nick, glad to have you here.
Happy to be here, Tom.
All right, wonderful. Hey Nick, so let's get into this. What is an assumable mortgage?
Assumable mortgage is essentially a government-backed mortgage that somebody can come in and take over if the agreements are met.
So when you say take over, does it revert back to the total amount that the note was, or what's remaining?
What's remaining?
Okay, so if I had a $300,000 assumable mortgage and I paid $100,000 down on it, the only thing somebody could assume would be the $200,000.
Exactly, and they need to come forward with either the $100,000 payment or a $100,000 second.
Oh, okay.
Loan.
So they won't expand it at that same rate, right? So your second would have to be at a different
Exactly.
interest rate. Okay.
And then
Wonderful.
another important thing is that assumable mortgage needs to be done with the lender who initially started that whole process. So whoever is holding that first mortgage, the whole process needs to go through that person up front.
Okay, so people are a little aware. Because you borrow the money from VIP Mortgage doesn't necessarily mean it was VIP Mortgage's money. VIP would be a servicer of the note, and the mortgage would be sold.
Exactly.
So you would be dealing with VIP Mortgage, a servicer, not the person who the note may have been sold to, correct?
Exactly.
Okay, so you don't have to track that down. You just go to wherever you write your check to, right? Okay. So, what type of mortgages are assumable? There's all kinds of mortgages out there. We hear about mom giving me a note, I got a buddy down the street, Guido, and he's from New Jersey, and he'll give you a note at a certain interest rate. And then you've got your FHA, your VAs, your USDAs. So let's talk about those. And then tell me a little bit about each one of those notes.
Sure. So your FHA is an assumable, your VA is assumable, and your USDA is assumable.
So they're all assumable.
Well, given that they meet the right criteria.
Okay.
And that right criteria revolves around the buyer. So as long as the buyer can qualify for the mortgage they are assuming, then the mortgage is assumable.
Really? That's interesting. I didn't think that FHA were assumable.
Yeah. So they're a government-backed loan, and so they fall under that category.
See, it's a school day. Every day's a school day here on the Nitty Gritty Podcast. So let's kind of talk this out a little bit. This is very interesting. I'm going to buy a house. It's a $500,000 house. There's a $300,000 mortgage on it. It was originally at $400,000. They came in with 20% down, and they borrowed $400,000. They paid off $100,000. There's $300,000. It's an FHA loan. They got it when there was interest rates was 2.9%. If I want to put an offer in on the house and I get it accepted, I can contact the seller's lender and say, I'd like to assume this loan. And the lender would, and I qualified for it, the lender would say, yes, just come to the table with more money.
Yes.
Now, the reason the lender would be willing to do that is because there's less risk to the lender because they have less skin in the game, right? Okay. Interesting. So why don't we see more of that?
Because most people are happy with just selling their home. So a lot of these will kind of revolve around someone who is trying to either sell their home quickly or they, they're in over their head and they're trying to get out before they get buried, by their debt. So it just kind of depends on, it's got to be the perfect person essentially.
Okay. So now I'm putting my real estate hat on. So if I have a client that I'm trying to sell their house, right? And I say, hey, this loan is assumable at 2.9%, provided you qualify, wouldn't that make the house more valuable? Because the buyer wouldn't have to go out and get a 5.1% loan for the whole kit and caboodle. Why isn't that shared more with the buying public? Is it because the banks don't make as much money? Because...
Yeah, so I think you're right with that one. It's more of a there's no extra money to be made essentially because it's all one loan.
Right.
So the banks make their money, when the loan is serviced. So when they're servicing the loans, there's not a second loan essentially being made there. It's just one loan being transferred to another person.
Okay. So in that case, what kind of qualifications in general do the buyer have to have in order to assume a loan?
So they need to qualify for, the standard. If it's an FHA, they have to follow all the FHA qualifications.
Okay. Certain credit scores?
Certain credit scores, they have to, meet the debt to income ratios. They need to have, they can't have too much debt, otherwise that'll affect their debt to income.
Right.
They have to make enough money. So it's just kind of the standard qualifying practices.
Okay. So as a loan officer, I go back to that scenario that I had a $500,000 home. There's a $300 mortgage on it. The borrower only has $100,000 in cash to come to closing with 20%. So we're still missing $100,000. Are lenders willing to work with a buyer like that to put a second underneath that assumable?
Yes, but it's typically more difficult because then you're going to be you don't deal with the same lender, you deal with a second lender.
Okay.
And so the lenders working together can cause some problems sometimes because you're adding a whole other set of variables and different underwriters, different loan officers, different practices.
Is that something that's frowned upon in the industry? Is it something that's not done because it seems to be kind of shady, or is it just it's hard to organize it all together?
I think it's because it's a more difficult process and everything, and so
Okay.
it's harder. Most people don't really want to come and do the second loan and as well.
Now, when you say most people, you're talking about the buyers or the lenders? The buyers.
The buyers.
Okay. But, I mean, realistically, in that scenario, at let's say a 3%, $300,000 note, right? And then you have maybe a 5 1/4 or 5 3/8 loan for $100,000. It's got to be cheaper than a $400,000.
Oh, absolutely.
So it may be behoove that. Now, let me ask this question: when you do assume the loan, what kind of costs are there associated with that for the buyer?
So you're going to pay a lot of your normal closing costs. The only really big difference is that you don't need an appraisal.
Okay.
So because you are, and the buyer and the seller are kind of meeting with an agreement that they're agreeing that this is the price, then and the loan is going to be less than that sales price,
Okay.
then it covers.
Okay. So some of the fees on an assumption, would there be like origination points paid on that too for an assumption? So is that like an assumption fee? Is that how they look at that?
And it may just be on the second, if they were going to do a secondary
Okay.
loan, that they would have the origination fees, because the loan isn't getting originated again.
Right.
It's going to be the same loan, so there shouldn't be any of those fees, but you might have some, title fees and things like that.
Processing fees and things like
Exactly.
that. Okay. Hey everyone, we want to interrupt this episode to let you know that we are a Keller Williams Southern Arizona franchise.
We are also realtors practicing equal housing. Now let's get you back to the podcast.
Can an investor, like a non-owner occupied, assume a loan? So let's say I'm buying the house from you. You're selling it, but I want to buy it because it's close to the University of Arizona, which is a great university, by the way.
Right on.
Did you graduate?
No. I grew up here, so I grew up going to a lot of U of A tailgates. And
So I'm going to buy your house, but I'm going to put renters in there. You have a great loan that's assumable. You got 2.25%. You've only lived there for a year, but you've got a new job in New York City. So you still have 90% of the value in the loan for the house. Can myself as a non-owner occupied, can I assume that loan?
unfortunately not.
Okay.
So a lot of these loans are specific to primary buyers.
Okay.
And so your FHA and your VA, they're all kind of revolve around a primary residence.
Okay. So it can't be assumed by a non-owner occupied. Okay.
But a fun little fact, a VA loan can be assumed by somebody who isn't part of the VA, isn't a veteran.
Oh, interesting. As long as it's their own residence.
Yes.
Yeah, you don't have to be a veteran in order to assume a VA loan. Now, when that loan gets assumed, does that take away the buying power from the previous veteran who was using that loan?
No. So in the end, there should be, if it goes through the whole process properly,
Okay.
there will be a process where they basically disconnect that the VA person from that,
Okay, and then they get all their full benefits and borrowing.
all their
power back.
entitlement and everything
Yeah.
back.
Okay, great. And so I've heard this bantered around a little bit. What's an accelerate or an accelerating clause within a loan, and then how is that all enforced and applied?
Yeah. So if you heard me earlier, I was kind of talking about how I've been using this word properly a lot.
Yes.
And I'm referring to the assumable mortgages, that you can assume a mortgage the wrong way, essentially. And if, like you were saying, you go with Guido, who's giving you a interest rate for a certain amount of money or something, that you're not really transferring ownership the correct way through the banks, through your title and through your loan officer. It's just an agreement, party member. That could be deemed as bad when looking at it from the servicer. And so the servicer could come to you and say, hey, we see that you're no longer living in this residence. You're having somebody else live here, and you're calling it a primary residence. Your loan is now due.
Okay.
And so they'll come at you for whatever the remaining balance is of that loan.
Okay, so that's when they would accelerate it. Okay, so what if you had a 20% or greater equity position? Would the bank accelerate it then? Because then you'd almost, or 25%, because that's what a non-owner occupied would have to come to a transaction with. Do you know that? Let's say there was only 50% on there, and I decided that I am going to rent out the house, not live there, but I've got this big equity position.
I
Would they
think
do
that would depend on the servicer and how
Okay.
they're willing to, if they're willing to work with you or not.
Okay,
Because sometimes they won't. They'll just
Okay.
say that, hey, you got this remaining balance, it's due, that you may have a chance to kind of refinance it, like you were saying, maybe, and using that equity to convert it into an investment property.
okay.
But it's kind of up to the discretion of the servicer.
Okay. So, Nick, I want to thank you very much. And everybody, if you have questions about assumable mortgages, what can be assumed, what can't be assumed, how to properly make the change, as Nick said, how do they get a hold of you, Nick?
They can reach me at my phone number, which is 520-449-3848, or at my email, which is nick.woolridge@vipmtginc.
All right, great. And that will be right down below here on the screen, all of Nick's contact information. Hey, Nick, I want to thank you very much for coming in today. I really appreciate it. I learned something today. And after 42 years, you think I knew everything, right? I did learn something today. I was kind of blown away by with the assumption of the FHA loan. So thank you very much.
Yeah, thanks so much for having me,
And
Tom.
everybody, stay tuned for our next podcast, which is going to be Equity Rich. Until then, America, stay safe.
Thank you for listening and watching the Nitty Gritty of Real Estate podcast here with the Tom J. Krieger team of Keller Williams, Southern Arizona. If you are interested in buying a home, selling a home, or even investing in real estate, we have 5,000 agents across the country that we can connect you to. If you need any free resources, feel free to check out our website at www.thetjkteam.com. We hope you have a great day.